Hi, everyone. I see quite a few of you are joining us already. Thank you so much. We'll give it another minute before we start the webinar. So if you do want to grab a glass of water, please do that now, and we'll start in about a minute or so. Thank you. Okay, great. I see we have quite a number of people who have joined us already, so we'll slowly kick it off. Hello, everyone, and welcome to today's webinar, which is part of our Flying Blind series on accounting, audit, and disclosure. My name is Nicole Kozłowski, and I'm the head of engagement here at the Tracker Group. The webinar today focuses on audit reports and the extent to which auditors are transparent over whether and how they assess the impact of climate-related matters in their audits. Our presentation will be based on our latest report, which you can actually download via the QR code on screen. We are aiming for a 40 to 45-minute session today, but definitely ending by the 60-minute mark, depending on how many questions we'll receive. But we'll start with a short presentation, then move to a fireside chat and the Q&A. We encourage you to ask questions. Please do so via the Q&A function. Please include your name when submitting a question. This allows the team to follow up if they're unable to address it during the live session. So, next slide, please. Before we kick it off, I wanted to take a very brief moment to introduce the Tracker Group to those of you who might not know us or are less familiar with us. The Tracker Group is home of Carbon Tracker and Planet Tracker. We are nonprofit financial think tanks focusing on the climate and nature nexus. Next slide. All the research translates climate and nature insights into financial risk and opportunities with the aim of accelerating the energy transition and aligning capital markets with planetary boundaries. You can see some of the themes that we're covering on the slide here. And moving on, all our work is publicly available and it is free to access from our websites, as well as the usual third-party investor platforms, which you can see on the screen here. So if you do have access to a Bloomberg terminal or you use platforms like Refinitiv, you can find our work on there as well. In addition, the accounting and audit work specifically can be seen on specialist sites such as Climate Arc's Transition Arc, the CA 100+, and the Climate Engagement Canada's website. So with this being said, and with the introductions out of the way, let's kick off today's sessions. Presenting the findings of the latest report today is Tino Gonese, who is the lead author of the report and an analyst in the capital markets transparency team here at Carbon Tracker. And joining Tino for the Q&A session are Paul Lee and Barbara Davidson. We're very excited to have you here. Paul Lee, he is the head of stewardship and sustainable investment strategy at Redington. And Barbara Davidson is one of our own. She's the head of the capital markets transparency team here at Carbon Tracker. Tino, we're excited to get it started, and over to you.
Thank you, Nicole, for that introduction. Good morning or good afternoon to everyone. Thank you for joining this webinar today. So as Nicole alluded to in the introduction, our purpose at Carbon Tracker is really to help investors navigate the energy landscape and to ensure that they have the information they need to future-proof themselves against these quite seismic changes that are occurring as a result of the energy transition. So to fulfill part of this mission, the primary focus of the capital markets transparency team is really on the financial statements and notes to the financial statements, as well as the related audit reports. For a refresher, financial statements are not just capturing historical information, they also include company forecasts on the future. For example, when a company is valuing an asset on its balance sheet or testing for impairment, it might use estimates such as future production, or if it's an oil and gas company, forecasted oil and gas prices to measure these assets. The company will also make assumptions on things such as estimated useful lives or how long they'll be able to use the assets or the timing of paying down liabilities like asset retirement obligations. It is also important to note that we only really look at highly carbon exposed companies, such as energy companies or transportation companies. These companies are companies with whose assumptions of future could be materially impacted by climate or transition related risks. These risks include emissions regulations, the transition to low carbon technologies like electric vehicles or solar power. Accordingly, oversight of these matters could lead to assets being overstated and liabilities being understated. Ultimately, this could impact executive remuneration, investor returns, and also the company's ability to continue as a going concern. Next slide, please. So another thing to add is that existing accounting and auditing standards already require consideration of material climate-related matters today. And since relevant regulators have also recognized this too. This really has been the foundation, or at least the basis of our work since our first Flying Blind report in 2021. And the third iteration of the series continues this research. So we had the overview, which just went over overall results, and then the regulator note, which delved into inconsistencies in regulatory and enforcement activities across different jurisdictions. And then finally, the audit note, which is the focus of today's webinar, which delves into the audit report results and potential ways to improve information provided by investors via those reports. So at this point, I just want to emphasize that auditors are crucial in maintaining trust in capital markets. They perform independent procedures to obtain reasonable assurance that the financial statements are free from material misstatement, and they also communicate the results of their work via reports. As such, transparency over how the auditor assessed whether a company's financial statements appropriately reflect the impacts of climate matters is vital. It gives investors added confidence that they have the information they need to engage with companies and to make capital allocation decisions. Next slide, please. So our work comprised of desktop reviews of 140 CM100 companies' audit reports, and sectors covered were like consumer goods and services, as well as energy, transportation, and industrials. And it also spanned across various different geographies whose audit reports are prepared in accordance to international standards on auditing or the US's Public Company Accounting Oversight Board standards. We believe that the standards that by both standard centers are sufficiently similar to require auditors to disclose climate considerations. Before we move on to the results, I think it's important to clarify that the results do not represent an opinion on the adequacy of auditor actions in the face of climate-related matters. They're simply an assessment of the comprehensiveness of audit report disclosures in regards to climate-related matters, considering accounting and audit requirements, as well as investor requests for more information. And next slide, please. So, as you can see on the slide, overall, we observed that most audit reports lack transparency on the extent to which auditors consider the impacts of climate risks and the energy transition. However, we do know that some audit reports continue to be exceptions to this rule. And just to explain the metrics, so for metric 2A, we looked at evidence of climate considerations. For these considerations to be meaningful, we don't just want boilerplate statements, but we're also looking for detail on what audit procedures were performed or conducted. For metric 2B, we assessed whether the auditor commented on the consistency across the company's reporting, particularly whether or not the company had a consistent climate narrative. For example, did the auditor comment on whether the assumptions and estimates the company used were consistent with its emissions reduction targets included outside the financial statements? And metric 3B is not really one that's required by existing standards. This covers investors' requests for auditors to comment on the alignment of companies' assumptions and estimates to achieving net zero emissions by 2050. In terms of performance by auditor, performance was generally similar. However, in financial year 2022, Deloitte was the only auditor to achieve yes for both metric 2A and 2B. And in financial year in 2023, EY's audit of Shell followed suit. Next slide, please. So different from other flying blinds, what we tried to also do was to delve into broader themes and broader trends. And based on our population sample, one of the things we did observe was that at times audit reports with longer tenures evidence less climate-related disclosures. There were also many audit reports we assessed which remained largely unchanged, going from 2020 all the way to 2022, even when the companies themselves that were being audited provided information on the financial impact of climate, either inside or outside their financials. We also observed that local offices of a singular global audit firm evidenced different climate considerations in their reports, even when you adjusted for relevant audit matters, company sectors, and even the same auditing standards. We believe that differences in audit firm practices across jurisdictions may be suboptimal, especially when you consider the global nature of some of these climate risks, as well as that investors and financial stakeholders often, allocate capital globally. And next slide, please. So before we go on to the recommendations, I thought it might be useful to illustrate some of our findings and bring them to life using examples. To this end, I'm using audit reports of companies in the same sector, audited by the same auditor under the same auditing standards. So Equinor is obviously a Norwegian oil and gas company with operations in Norway, but also in locations such as Asia, Northern Africa, and the United States. This is a company that has been audited by EY since 2019. Under its primary filing, it is audited under the International Standards on Auditing, but it is also listed in the US as such. It is also audited using PCAOB standards, and a separate audit report is provided accordingly. In the PCAOB audit, which is similar to the International Standards on Auditing audit report, we noted that EY evidence consideration of climate. This included assessing the impact of climate matters on the company's carbon cost assumptions. It also evaluated sensitivities provided by the company, such as those that reference the IEA's net zero emission scenario. EY also indicated that it evaluated the consistency of Equinor's climate narrative. And if we compare this to EY's audit of Conoco, so if you go to the next slide. So as you can see, it's quite a change. So ConocoPhillips is a US oil and gas company, but also has operations in Asia, North Africa, as well as a significant portion of its exploration and production assets in Norway. However, as you can see, there was no indication that EY considered climate matters in its audit on Conoco. Similar to the audit report from Equinor, EY identified audit matters on accounting of asset retirement obligations and on the depreciation of oil and gas properties. And the screenshot you see on the slide is of how EY addressed the depreciation audit matter. And throughout, there was no mention or reference to climate. So it was unclear whether EY assessed the impact of transition risks like emissions regulations or the transition to EVs on relevant estimates such as oil and gas price assumptions or future production estimates. This is despite increased discussions by Conoco outside the financial statements, such as, Conoco provided an additional risk factor on the impacts of climate change efforts on its business in its 10K. So overall, when you compare EY's audit of Equinor and of Conoco, you see that investors have less transparency on the audit work done for Conoco. This may be concerning, especially as there's a lot of crossover in the types of assets and where they are located for both companies. And if we go to the next slide really quickly. So I won't really spend that much time on this slide, but here we tried to compare audit report scores by auditors and also ordering it by auditor vintage to demonstrate our points about tenure, but also about global consistency. You can also look at this further. I believe the slides are publicly available now, and also there's more detail in the audit report itself. So if we go next to the recommendations. So the key recommendations we had in this report, amongst others, were for auditors to ensure that their audit reports and the disclosures within them are useful and shed light on how they went about in assessing the impact of climate change and the energy transition in their audit. They should also review disclosures on a global level and to ensure that disclosures are reasonably consistent across the network firm and sector. This helps to improve the quality of audit reporting and also to improve the comparability of information needed by investors. And then if we go to the next slide. And for regulators should really assess the quality of audit reporting in relation to climate. They should also consider the appropriateness of existing tenure rules and the impact that audit tenure might have on audit reporting, as well as improve coordination across jurisdictions to promote consistency in audit report transparency globally. And finally, in the next slide. Yeah, thank you. And lastly, we recommended that investors should engage with audit committee members and auditors on the quality of audit report disclosures. This is particularly important if they feel they do not have the information or the transparency on the extent to which the auditors assess climate matters. Investors should also ensure that voting policies include considerations such as audit report transparency in relation to climate matters and also audit firm tenures. But yeah, I'm going to pass on to Nicole now.
Great. Thank you so much, Tino. A lot of food for thought here. And to help us unpack these findings a little bit further, I'm delighted to now invite our guests, Paul Lee and my colleague, Barbara Davidson, for a short fireside chat. Barbara, Paul, over to you.
Thank you. Thanks, Nicole. And thank you, Tino. That was excellent presentation, summary of this report. Paul, thank you so much for being here with us today. We're really excited to have you. What we want to do is kind of delve into some of these findings and your reaction to them, given your investor background. But before we do that, before we get into some detailed discussions on that, I thought it might be useful if you could talk a little bit to the audience about your prior work on audit report transparency and also how investors were using that.
Sure. So, yeah, to an extent, this is my fault, I'm afraid. So I was on the UK's Auditing Practices Board when we invented these enhanced auditor reports. Up to that point, really, auditors' reports were not worth reading. There were a couple of pages. They provided a tick, yes, we've done the work and it's okay, and not much beyond that. And now, actually, we do get some fuller insight into what the auditor has actually done in practice. The UK standards were followed in the US and globally. So, although they're not quite the same standards, they're something close to. So there is comparability internationally, as Tino says. There are sort of three key elements of auditor reports. There's the scope of the audit, what's been covered, and you'll find that for oil and gas companies, because you've got quite a lot of separate operations, the actual direct audit doesn't cover that higher proportion of the overall assets, sometimes around sort of 60%. There's materiality numbers, so how big a problem could the auditor have ignored, and sometimes those are really quite big numbers because we're talking about quite big numbers at oil and gas companies in particular. But the main discussion that Tino was pointing us to is the third element of auditor reports, which are the key audit matters or the critical audit matters. They're called slightly different jargon internationally. And that's the discursive element of the auditor reports, and that's probably where the real value lies for investors, certainly the more accessible end of it. How do investors use it? Not enough, I think, is the first answer. There's real insight and data to be had in these reports. I think they still get too ignored. There's a bit of jargon in there. It's a little bit hard to read on a first attempt. Auditors could do a better job on making them more accessible. But with work, investors can get real value out of this, as Tino's analysis demonstrates.
Thanks, Paul. I know that the high-level overview of that is not probably giving all the work you did justice, but really appreciate that. Yeah, so if we kind of delve into the part about the climate-related discussions that we look for in our work, which often we would look for in the scope or in the key or critical audit matters. Yes, why do you think, as for investors, that these discussions are important?
So, I mean, I think people very often think about financial reporting as being wholly backward looking. You know, it's just about what the company's delivered. But of course, company accounts include a hell of a lot of forward-looking numbers, a lot of numbers that assume certain ways in which the world is going to develop. And for the sorts of companies that we're talking about today, you know, that will include oil and gas prices. It will include assumptions on the costs of extraction. I mean, Tino talked about the asset retirement obligations. I think that's a great example of an embedded number in accounts that's based on a large number of assumptions about the timing at which production will cease from an asset, the cost of remediation as and when that happens, and the discount rate that you apply to that cost over that horizon. And those are three crucial assumptions that drive a number that we see in the accounts. And the sensitivity to different assumptions can be very significant. And auditors ought to be able, and the best audit reports do give us the insight into what those numbers are and what the sensitivity might be to small changes, which could have very substantial effects to the reported numbers. We've seen a couple of companies, Barbara, haven't we, in the last few months, announce some very big write-downs because of changes in assumptions, because of closures of plants, and that is has been a shock, I think, to some in the markets, which perhaps wouldn't have been there if we'd had more disclosure in this way.
Thank you. Sorry, I missed the unmute button. Yeah, those disclosures that we're talking about, which for the audience are specifically some refining companies in the US that have been booking some new asset retirement obligations that were previously, it was really unclear for those auditors and companies how climate had been considered before these obligations were actually booked. So why they weren't booked at the end of last year versus in the first quarter this year. So it is, yeah, it is an interesting lack of information. I suppose, so we saw Tino talk about the differences across jurisdictions, and we do see actually where we can, if you look at the same audit report, the same auditing standards for jurisdictions like the US, but the company being, you know, locally in a different jurisdiction, how the information might be different. But when there is different levels of climate consideration across the jurisdictions, what does this mean for investors? Does it negatively impact how they're assessing the companies and making their decisions?
It's clearly not helpful to have, you know, any artificial differences in the insights that investors can have, and it's particularly odd, I think, in the audit market when you have the audit firms that tell us very clearly how international, how global they are, that we can find these degrees of inconsistency between what they're delivering in practice in different markets. I think the other really striking thing is that there's a difference in what is reported in local jurisdictions' annual reports and the 10Ks that are issued in the US, and you can see in a number of cases how the key audit matters in a local jurisdiction's annual report differ from the critical audit matters that are disclosed in the 10K, and that just feels very odd, and does not encourage investor confidence. Let's just put it like that.
Yeah, it is very odd, especially if you have companies that aren't filing both those reports. So you don't know if you know for those companies that you're talking about that are dual listed in the US in their form, their US filing, if the auditor talks about it, what the auditor did. But it is, I imagine, quite difficult for investors to understand what happened in those filings that don't say anything. So this comes to one of the, I guess, what we would call potential levers in hoping to make change, obviously understanding the existing requirements that are there today. And so Tino talked about this indirect relationship between audit tenure and what we're seeing in terms of audit quality, which was the proxy is through the audit scores, or audit report quality, I should say. By the way, when we look at these scores are not a reflection of what we think the auditor did. It's just a reflection of what we have evidence of them doing. So we don't know what they did. So having said that, how do considerations such as audit tenure, audit firm tenure, feature in investor proxy voting guidelines if they do?
Yeah, I just on that point about the confidence about what the auditors are doing, and the report is our only way of getting insight into what the auditors are doing, and I think in some jurisdictions they're underselling themselves. They're not showing their wares in a way that actually would give investors greater confidence about what they're actually delivering in practice, and that's a shame for the audit market, frankly, and it's one reason why we tried to build a better reporting standard to enhance insight, enhance understanding, and actually to give a window into the audit activity. So forgive me. Audit tenure you actually asked about. I'd love to be able to agree that it's tenure that's the driver of the differences that you've identified. I think I'd struggle to agree because it's hard to differentiate between the tenure and the US nature of those companies, because it's basically the US where auditor tenure is not constrained. There's a couple of other markets, but it's mostly the US. And we're just seeing less clarity through the auditor reports in the US market than we're seeing elsewhere. I'd love it to be real evidence that tenure was the issue. I've been a long-standing supporter of constraints on auditor tenure because it actually does encourage a fresh pair of eyes, a fresh thought process around the audit, and a new challenge of the assumptions that a company has made in its reporting that just adds value. It's a new opportunity, and I think there are a couple of examples that you found in the report where a change of auditors did seem to lead to a slightly different level of transparency, and that's clearly helpful. It's that fresh pair of eyes having an influence, and that's hugely valuable in and of itself. Just the human dynamic of not being from the same firm, so that you can implicitly criticize what went before. If you're from the same firm, it's really difficult to push a boundary, to ask for something different, because your colleagues have signed something off previously.
Yes.
What are investors doing on tenure? Very quickly, I think increasing numbers are applying a global standard on auditor tenure. We're seeing that have an impact on voting numbers. It's not particularly high in the US market, which is, as I say, the main one where auditors have long tenure, but it's very often towards the 10% level of a vote against. There, Canada and Switzerland are the other two leading markets where you do also have longer tenure of auditors, and there have been a handful of really chunky votes against in those markets. Air Canada, I think I saw about 25, 26%. Swatch in Switzerland, 31% of the free float voted against. Roche, 16%. Bunge, the commodities business, 18%. So, you know,
Wow.
these are quite sizable moves that say actually we're quite uncomfortable with the long tenure of auditors. On the other hand, we do still have the situation where, for example, Procter and Gamble in the US has been audited by the same firm since I think 1890.
Wow.
So, you know, there are some markets where a little bit of change wouldn't go amiss.
Okay, well, I think we only have one more question. I see someone flagging that to me. So I actually would like to ask about what actions investors might take if they don't receive a decent level of transparency in the audit report so that they can understand, especially with respect to climate-related matters and what the auditors did.
I think in pretty much every market in the world, the investor has a vote on the report and accounts. They have a vote on the appointment of the auditor. They often have a vote on the remuneration of the auditor. There's and even if those aren't annual, there's a regularity of those voting opportunities. Those are obvious ways to express concern, and I've mentioned some situations where clearly investors are expressing concern, you know, about a narrow issue of auditor tenure. But I think if people do not feel they're getting the quality of reporting from auditors, that would be a formal mechanism to do it. I think many investors might want to encourage before they take that more formal action, but that fallback is always going to be there. But you know, having dialogue with the audit committee, it's harder to have dialogue with the individual auditor. They're always a little bit nervous about talking about individual companies, but they are more open to having broader conversations about the market as a whole.
Right.
And there's one final thing that I would just encourage investors to think about is actually the importance of these standards that we've talked about, and investors can have an influence on that. There is pushback against the PCAOB standard setter in the US at the moment, and if people value the reporting that we're getting, and it's better than what went before, even though it has gaps, it might be worth making sure that people hear that message, that there is value here, rather than seeing further pushback against it.
Thank you, Paul. I know that was a real big whirlwind tour of your views, and I'm sorry we couldn't pick your brain more, but we really appreciate you being here and answering these.
My pleasure.
Offering some clarity. So I think we're supposed to go back now to Q&A, and I don't know who's in charge of that. Is that Nicole?
Yeah, and we'll get Tino back on screen as well. Thank you both for this conversation. And yeah, we'll go through the questions now that you have posed in the chat. Just as a reminder, if you do have any questions, you can use the Q&A function at the bottom. And Tino, I think I'm just going to start with you, actually. And our first question is around metrics and essentially the metrics that you consider to be key regarding climate change for fossil fuel company reports.
Yeah, so I mean, in terms of metrics, I think if we're talking about specific balance sheet items that might be impacted by climate, these are typically like items of the balance sheet that which require future forecasts or forecasts of the future, which might be impacted by climate. Sorry, one second. Just the door. Apologies. You know, you can tell it's a webinar because nothing always goes right. So anyway, as I was saying, so the you can certainly look at certain items on the balance sheet, and those assets could be large items like PPE, manufacturing assets, or liabilities, as we've mentioned already, like asset retirement obligations. And these are items where, in order to calculate, you need to, or management needs to be making some forward-looking assumptions about, right? And in terms of how we assess it on our assessments, we have metric 1A, which looks at the extent to which management has considered the impact of climate on certain items and the focus of these items. And then 2A for the auditors, which looks at what procedures the auditor undertook in order to evaluate the reasonableness, as well as whether or not certain management's assumptions were correct as well. And yeah.
Great, thank you, Tino. And I might just post the next one to you as well. And actually, it's something that came up in the conversation between Paul and Barbara as well. And it was about the relationship between audit tenure and the nature of audit reporting. And you're being asked whether we have analyzed the differences between companies based in the US versus Europe, for example, or maybe other jurisdictions as well.
Yeah, I mean, that's certainly like a large portion of the report, so I would refer to the report. We do try break down by tenure, what the performance or how we scored US companies, and also put their tenure next to them, and then compare that with some European peers, usually in the same sectors, usually audited by the same auditors, really. And there did appear to be a gap. And I would say, like, generally, the UK auditors tended to perform based on our assessments better than even the European peers. But yeah, that's all covered in the report as well.
Great, yeah, and hopefully everyone has downloaded it. The QR code will be back on screen afterwards if you haven't. And Barbara, maybe one for you here, actually. And again, that came up in the discussion. You were talking about some of the surprisingly large write-downs. Could you maybe go in a bit more detail and provide some examples on that?
Yes, thank you. I was frantically trying to find more information while we were sitting here, so I might have to get Tino to help me, but I'll just give the overview and then Tino can give specifics. I mean, we've seen at least two refineries in the US that are operating in California say they're going to be shutting down their refineries. One is Valero. Of course, I've forgotten the other one already. I'm sorry. We just did all this work.
It was Phillips 66, wasn't it?
Thank you. So, and this was aimed at you, Paul, if you want to answer it instead. Basically what we saw is these companies are saying, Phillips and Valero are saying that these they're referring to challenging regulations in California that is going to impact the future operation of these refineries and their ability to perhaps provide enough, sell enough of the output of these refineries to preserve the value. Plus, they're not going to be able to convert these refineries under, to say, for example, chemical parks. Without the numbers, I would say the numbers, I think, were in at least $1 billion each company for those, and Tino can help with the details. But before Tino jumps in, I just wanted to say a couple more things. One, we have the detail in our response to the FASB's agenda consultation. We can send a link to that after this call. The other thing we found disturbing is that there was an acceleration of life of the asset, if you will. So basically, we don't know what the remaining life of these refineries was before because the company wasn't giving the right information. But now the company's saying we're actually going to shut it down next year, which means we have a significant increase in the future depreciation expense, plus for the next year, plus an impairment write down. So there's a big impact on profitability in the next year, which is a distortive impact, if you will. And sorry, Tino, I'll let you go to more detail.
Yeah, I mean, in terms of the specifics, really. So Valero, I think at the end of Q1, reported that it would have to shut down its Wilmington refinery in LA, as Barbara said, and as a result, it recorded, I think, $1 billion of impairment, as well as recognized an additional 337 million in regards to asset retirement obligations. And so, for some context as well, prior to this reporting, Valero hadn't necessarily recorded any material asset retirement obligations, and within their financial or the notes to their financial statements, they kept on saying that their assets have indeterminate lives. As such, it's not reasonable to record asset retirement obligations. And a similar thing happened with Phillips 66, where they also closed one of their LA refinery, as Barbara mentioned, and this led to like an increase of 234 million in asset retirement obligations towards the end of financial year in 2024, and led to a shortening of asset lives of that refinery, obviously, and the asset value of that refinery was depreciated all the way down to 1.2 billion. To have a salvageable value of 241 million by the end of 2025. So that's a loss of more than 80% of that book value of that refinery. And yeah, that's all the detail on that.
Actually, I wanted to add, these are actually fascinating examples because they show the lack of information provided previously by the company and the auditor. The other thing I wanted to say, which Tino had mentioned, was the recording of one of the asset retirement obligations was the first time the company had recorded asset retirement obligation for that refinery. And as recently as year end, December, the company was saying they didn't have, they basically thought they were going to use the assets indeterminately. So going from saying they're going to use an asset indeterminately to saying, well, actually, we're going to shut it down in 12 months is a significant change. And this is why more clarity and transparency is needed over both what the company is doing and how the auditor looked at it.
Great. Thank you very much on all this detail. And Paul, maybe just following up on that, we were just speaking about the asset retirement obligations and oil and gas companies. We have a question here on whether, according to you, there are other key topics that are currently not properly reflected in audit reports.
I think I'd probably refer you to Tino and Barbara's excellent report. I think the other key area where they identify gaps, and I would certainly agree that there are gaps, is just around PP&E valuations and the lifetime assumption, or the life assumptions built into them for the future life of those assets, which may not be consistent with our understanding of climate change and the carbon constraints that we are heading towards. But it's going to be difficult, I think, for many of these assets to be of the value that they are booked in at.
Great, thank you, Paul. And one for the team. Charles is saying that investors should expect the material information they are interested in and related to financials in the financial statements. And if this can only be got from audit reports, preparers haven't done their job properly. So shouldn't auditors be putting pressure on preparers to report properly rather than providing the info in their reports? Barbara, do you have a view on that?
Yeah, so Charles, hi, Charles, by the way. Yes, both the preparer and the auditor should be providing more information in both the notes to the financial statements and the audit reports. This report that we wrote is focused on the information in audit reports. Clearly, the preparers, the auditors should be working with their preparer, with the company, to ensure that the preparer is providing sufficient information for investors. However, if they are not, the auditor can still flag the work that they did in this matter. Like if there was, for some reason, a negotiation with management, and management didn't put this information in the notes, the auditor can still put information in. But interestingly, actually, we're seeing the opposite. So we're seeing audit report disclosures lag behind preparers. So even if the company that the auditor is auditing is providing some information about how they've considered climate risks or other matters in their notes, we're seeing that sometimes even the auditor doesn't say anything about that. And so, I mean, obviously the assumption is the auditor looked at this, but we want investors, this is the significant, financial market risk, and we want to understand how the auditor looked at it. So actually, we're seeing less information from the auditors than we are from the preparers. But overall, yes, they should be both providing better information.
Thank you, Barbara. And I have one final question here, and that one is for you, Paul, and that's actually on the role of investors in this. So what is the best way for investors to raise concerns with audit committees? And maybe related to that, should they engage directly with the auditors?
So I think it's very difficult to engage with an auditor on an individual company. They will feel rightly constrained in talking freely to an investor about any individual company. Many of the firms do have scope to talk to them, and they hold open meetings for discussion with investors, talking about a broader range of issues. And I think there is an open door there to talk to the auditors about the general expectations that investors have in this area, and in reflection of what's in the report. There are also opportunities, I think, to talk to the regulators and to the standard setters, and to reinforce investor needs for disclosures in this area. And I think a broad approach would be really helpful from the investment industry on this.
Thanks. I think these are great closing words on kind of investor action, on what to do going forward for our audience here. So I just wanted to say thank you very much to the panel. Thank you very much, Tino, for the presentation. And also thank you very much for everyone who has posed questions. There are quite a few more. If we couldn't get back to you, we'll get back in touch. But before we wrap up, I just wanted to bring up what else we have coming up. For anyone of you who is interested in nature-related financial risks and opportunities, I do invite you to join my colleagues at Planet Tracker on the 5th of August to explore the latest research on the food system, particularly on seafood, on agricultural methane emissions, as well as a deep dive into how to use the latest chemical sector climate alignment data dashboard. That's a very long word. So do use the QR code on the screen to sign up. And also just wanted to highlight some upcoming company research. On the Carbon Tracker side, we will be publishing transition assessments of 3 companies in the next few weeks. The first one up is BMW tomorrow, followed by a report on Bayer, and then later next week on Tata Steel. If you do want to stay updated on that, sign up to our mailing lists, which you can find on our website, and you'll get everything straight into your inbox. And that brings us to the end. Again, thank you very much to all of our speakers, and of course also the team behind the scenes for organizing this webinar. And thank you to all of you for engaging with us this afternoon. If you do have any further questions, do reach out and we'd be happy to help or point you to the right direction. And otherwise, I hope you have a lovely rest of the day, and we'll see you at our next webinar. Thank you.
Thank you.